Hello, hello, hello. What's going on, everybody? Welcome now, Stock Trades. How's everybody doing today? All right, ladies and gentlemen. So let's go ahead and get straight to business. We're going to go ahead and talk about Opendoor and if there are potential possible short squeeze. Now, listen, guys, as you know, we're completely data-driven. So normally I was going to be activating this only for lifetime access members, but I went ahead and created this scientific document that has over 591 institutional transactions. And we use multiple layers of mathematics modeling, so mathematical modeling, volume weighted institutional distributions. We use institutional selling probability. We're using critical threshold analysis, figuring out when will institutions start selling the bag on retail investors. And everything that we've done here based off of the p-values, it's all statistically significant with a p-value less than 0.001 and 0.05. We went ahead and looked at and did a scatter plot regarding institutions buying, selling, holding. We did a supply overhang quantification, which I'll explain what that means, and a whole slew of mathematical modeling systems to help retail investors be able to at least understand from an educational standpoint when institutions are going to sell them the bag. Okay, so you got to be careful with this, all right? So the problem is you cannot basically go in front of a pep rally, bring a calculator and say, you know what, there is no economic value here because it's unprofitable when the stock price is going up, when you have a potential possible short squeeze. But the problem that a lot of folks need to look at here, and we're going to be talking about this in our deep dive educational research division here, is, and again, I've been doing this for over 14 years, okay? I've designed my own platform that's helped people amass a total combined net worth of over $45 million. It's helped me become a multimillionaire, and all those things are essentially going to get passed on, hopefully, in this video through some good education. So the issue is, this thing has the potential of going up, but you don't want to be stuck holding the bag. Now, let me just kind of give you the reality here. This is like the Hunger Games, okay? And you have to understand that the people that are pushing you to buy are going to be the people that want to sell to you. It's a pyramid scheme in the beginning. When you buy a company, you want to make sure the company makes money because ultimately that money gets translated into the stock price. And that's for the long term. In the short term, when a stock skyrockets and it's not backed by fundamentals, then it is a gamble. So when you look at this here, Chase said people are going to make stupid money on the stock. It has nothing to do with fundamentals. Momentum is all that matters, right? And I told him I heard the statement before where fundamentals don't mean anything. And, AMC was that last one that someone said that. And he said, "Our stock trades doesn't matter where it is at." And so I told him, look at where AMC is at now. And this is where you need to open your eyes. He said, AMC, right? So Al stock trades, it doesn't matter where it is now. AMC skyrocketed and many of us banked. So who's many of us? And how about the people that got stuck holding the bag? So he is correct. AMC did skyrocket and many of us banked. But a lot of people got caught holding the bag at 98 cents. Understand the reality right now. There's going to be a lot of people that are going to actively pump the stock. There's going to be people that bought at 60 cents. A lot of people in my group, they went ahead and took a speculative bet because we went ahead and made past videos before this whole short squeeze, Eric shenanigans. We made multiple videos regarding Opendoor, and we calculated the arithmetic mean was around the book value of around 89 cents going all the way down to 30 cents, and 51 cents ultimately was the low for open. And the arithmetic mean was around 2026, which means that it was being priced in at 2026 levels. So obviously they took an asymmetrical opportunity here. But the problem is is those people that bought at 50, 60, 70, 80, 90 cents, $1, $1.20, $1.50, they're going to be the ones that are going to be actively trying to pump the stock so other new people can essentially buy to increase the stock price. And remember, again, doesn't matter where it is now. So they don't care if you buy it at $10 or $15. They don't care because it's already skyrocketed for them, and a lot of them banked. Again, this is like the Hunger Games, all right? And the whole point of the Al Stock Trades platform, right, the platform that I designed, was to help retail investors get a fair shake on Wall Street, right? And also to help you not to destroy the hard-earned money you worked for, right? If it's daddy's money, that's fine. But a lot of people don't have daddy's money, okay? So our platform uses data and essentially no emotions, okay? So I activated the chat now. You can show the chat now on the thing. I don't believe that. It's probably, the volume is low, so I don't think that's real for the Clover $3.50. Let's see here. Yep, we're definitely rocking. Just looking at the comment section. Feel free to comment. It'll show up on the screen. Again, I'd like to enjoy active discussion in community for all those things. Okay, so again, guys, you don't want to be caught stuck holding the bag. Okay, so now, we already talked about this yesterday. Okay, so this is the research we've done. We went ahead and stated that we're going to be going live. So let's explain what's going on. So this is a quantitative analysis of institutional trading patterns. This will tell you exactly when institutions, the big dogs, smart money, is buying. Now, this document is a stark difference than the Clover document. If you want access to the Clover document, we're not going to be releasing it publicly because we need to get that edge. That's our edge amongst the public for our lifetime access members. So we know exactly when to sell, and we know exactly when institutions are selling. So we can basically figure out when's a good time to do a covered call, because there's going to be a lot of institutional selling in that arena. So our covered calls doesn't take a hit. But overall, we examined over 591 institutional transactions from SEC 13F filings, government legal documents, right? We developed a mathematical framework that reveals coordinated distribution strategy at a specific price threshold. Overfinding indicates that institutions are engaged in systemic risk transfer. So what is a risk transfer? A risk transfer is when they're basically allocating and transferring their risk onto the shareholders, right? So look at BlackRock, right, with their de-risking and rebalancing. A lot of these institutions are going to ultimately end up transferring their risk onto the retail investors, right? Because ownership, I'm sure it's going to start going down, right? It'll be interesting to see, unless the algo stepped in and truly they're about to become profitable, which again, I haven't seen from the earnings report. So unfortunately, this is going to be profit taking, and it's going to be, defensive liquidation rather than opportunistic selling. So here's the selling pressure index. And I'm just going to cut straight to the chase for folks that are part of Lifetime. You can understand the mechanics of how we basically got all the mathematical models. Again, guys, this is the same type of mathematical models that a lot of hedge funds have. And what we do here at Al Stock Trades is we take this and democratize it to retail investors around the world. We have access to over 2.5 billion outputs of institutionally graded data, and we've generated multiple multimillionaires because of the first principles analysis that we provide. So, let's scroll down. Again, we can just read all this stuff here. Fine. We'll give you a little bit of this one here. So if you go to this section right there, it's if you're thinking of buying open at $14 and this equation shows that 57 to 86% institutionals are selling, you're essentially buying shares that are smart money is desperately trying to get rid of, right? So it's like buying a house when 8 out of 10 neighbors are trying to sell their shares. Now, why do I say that? Well, it goes back to this post here, right? It goes back to this basically post saying something's not adding up. So there's a gentleman by the name of Eric Jackson, a founder of EMJ Capital. First, he said, $82 shares. And now I'll explain what happened. Because now he changed it. Now he says $40, right? Again, very interesting, right? So again, I would love for him to respond, but he hasn't done so. But I love to, again, this is a Twitter town hall or X town hall. I know, we encourage debate and discussion, and from a respectful, just being respectful, right? So, okay. What I found interesting is that Eric, EMJ Capital went ahead and bought 62,000 shares of Opendoor at $16, but then they sold at 14, right? Then he bought at 9, and then 3 months later they sold at $55.66. That's a 41% loss. Then right after a 12% loss, and then he bought back in at $4.74, and then sold at $1.16 for a 75% loss. Now, again, if someone is truly thinking, at least for me, I can't speak for him. But if I, like, for example, like when Clover went down, I doubled down, right? And my cost average now is super low, and I'm profitable, and I've made a lot of millions off of Clover, right? Especially last year when I did the cover calls and cash secured puts, and they were printing, right? I was making like 10 to 15% per month, right? Okay, so while still holding my shares, amazingly, right? So now with that, you can see the trading histories over here. There is no bullshit. Investor holdings, and this is our proprietary data, investor holdings is decreasing, right? So it shows that, institutions are selling, right? So again, listen, guys, it's always important to look at what the big boys are doing. Again, normally we see retail investors, talk like this, but now we're seeing hedge funds that have an obligation, with their FINRAs and everything to be able to help with, because people look up to these folks. And like, for example, I'm not a financial advisor, and even though I've taught a lot of folks for the MBA, I don't want to get my financial license because then I have an obligation to always be fiscally responsible. And there's like laws extra for you that you have to follow based on the criteria. And again, I think this is just really, it's just something that just does not add up here, guys. Okay. So what I'm fearful for is a lot of these people are basically saying these high price targets, but in reality, if you look at the data using all this math, I mean, has Eric shown you this math? Has other people shown you this level of detail of math? This is this type of stuff that we do, right? And what the data is saying is that institutions are selling hard around these levels. But let's continue to scroll down and look further. So I'm just going to scroll down. So, if institutions bought open at 13 and the stock hits 14, this formula tells you that there's a very high probability they'll start dumping shares. It's predictive, not just descriptive. And it makes sense. Why did, EMJ Capital sell at $14 and whatever cents? What was it? They sold at $14.61, which you can see in this filing here, right? You can see they sold right around, one was $14.61. That was on December 31st, which was right here. They sold 62,000. They sold all their shares. Okay. So again, it just doesn't make sense, right? So if you look at the critical risk threshold analysis, you could see that this is institutional selling pressure by price range. There's really not a lot of selling pressure here, 12.8%. Then anywhere between $2 to $4, selling pressure goes up to 34.5%. But really, again, 26% at $4 to $6. Then at $6 to $8, it's 37%. But really, it starts to go up here when it starts to, when it's over $8, over $10. You have institutional selling pressure where institutions will definitely start dumping on you. And this is basically, 44.4%. Then when you get to $12 to $14, that's 57% of institutions they're going to be dumping on you. So who's going to absorb that, right? You're going to get retail investors most likely taking that and absorbing that. And you can see from a volume perspective, and if you go ahead and pretty much look at Open's volume for the week is, and you can look at this number here, right around here, you could see the volume was 1.74 billion, right? So if you go ahead and use our stock terminal, which for folks that are interested in getting access to this level of research from an educational perspective, use coupon code SAS, $1,200 off, right? And then you'll be able to see, so again, for Clover, which we've done the analysis here, you'll be able to see that they're buying, and it'll show you exactly at what prices they're buying at. And that's the difference, right? You'll be seeing exactly when they're buying and when they're selling, and that's just so powerful, right? But again, so if you go ahead and look at the financial data and analytics metrics chart, and if you go ahead and take a look at Clove here, if you take a look at Open, and if you go to shares, they have about 699 shares, right? So around like 700 million shares. If you want to get more of an accurate share count, you have to go to our advanced price target and just hit Open, and you'll see the most. This pulls it directly from the SEC documentation. That's about 729.13 million shares. So you're telling me that the trading volume was double that, more than double that, or around double that, right? So pretty much double that. So what does that mean? That means the whole flow has been people are playing hot potato. That's what people are doing. They're playing hot potato because people don't understand how shares work, right? People are just passing on their shares at a higher price, right? And my fear is once we get to these levels, once we get to these prices, there's going to be, unfortunately, new suckers that come online, and they're going to buy from the people that bought before, and institutions and retail investors that are pushing the stock online, which is unfortunate. They're going to ultimately end up selling to these people to hold a bag. And then if you ask them, they're going to say, hey, it doesn't matter where it is now. It's, AMC skyrocketed, let's say Open skyrocketed, and many of us banked. But a lot of people that bought at a higher price target here at $12, you can see, like, as the stock price goes up, and this is all data driven, guys. This is all from institutions, not retail investors. These are big boys, right? You can see there's not a lot of sellers down here, but when you come up to here, there's a lot of sellers, right? So just like someone said, this is musical chairs. Again, guys, we can go ahead off the hype cycle. I can go ahead and say, buy this, epic short squeeze, go ahead. But the problem is you have to understand the truth of what you're getting yourself into. So then we could go ahead and do a statistical analysis and look at the probability tables and look at p-values. And we could say that, from 3 to 4, the risk classification is high. They could still dump on you at $3 to $4. They can dump at you at $8 to $9. But guess what? Once you get to $13 to $14 or $18 to $20, from pretty much from $13 to $20, you have an extreme probability that institutions are going to dump on you. They're going to dump on you so hard that you're going to be caught stuck holding the bag. Okay? And that's unfortunate, right? Because what's happening is that when you buy Opendoor at these prices, you're pretty much buying Opendoor at, let's say, 2026, not even that, probably 2027, 2028, and 2029 levels. You're buying Opendoor so far into the future, but like, what happens if they don't get to that evaluation, right? Then you're screwed, right? So again, guys, it's very dangerous, right? And then if you look at the institutional trading activity, there's been a lot of buying here from anywhere between the $0 and I would say $3 region. Lots of buying institutionally, right? Definitely, from this region. Right. But then guess what? What happens to the buys after? The buys after becomes dispersed. It becomes weak with this plot. Right. But then even the holdings become weak. But guess what? Selling, there's a high density of selling near the $5 region. And then there's huge pockets of selling here. And then definitely strong densities here, which you basically have seen from this data set where we extrapolated. Again, this is all done mathematical, computationally, utilizing statistically significant algorithms that hedge funds have on their desk. And we essentially do this analysis and we provide it for retail investors. We go above and beyond. Okay. So for folks out there that want to weigh out, that actually want to learn how to make $200,000 to $800,000 per month, because that's what I'm doing, this is the path. Okay. But ultimately, you got to understand that if you do go into a short squeeze, you have to understand that institutions will be dumping on you. And also people like this that are playing Hunger Games, like, the end episodes of Squid Game, where, they'll basically say Open skyrocketed and many of us banked. Who cares where it's at now? They don't care about you holding the bag. It's like that bully who's basically trying to make you get into a fight. We're telling you to go fight that person, and then you get in trouble, and all of a sudden that bully's gone. That's the whole game. It's tribal. So be smart. Don't be stupid, okay? All right. And again, it is what it is. You do whatever you want, but at least for the folks that are going to be buying at, like, who knows where this will go, 5, 6, 7, 8, 9, 10. And if you lose your money, don't cry to the SEC. Don't cry. You're not a victim. You're an idiot. Okay. You're an idiot. All right. So we can use advanced statistical quantification methods, which is called supply overhang. And you could say at $14, this formula predicts 23.7 million shares of institutional selling pressure. So that means that's like having a dam burst, and there's no way retail buying can absorb that. So most likely the stock price could go down from $14. But guess what? If retail investors with this trading volume, if retail investors come in, they could absorb that. And guess what? More institutions are going to be selling them. They're going to be pretty much offloading their load. They're going to be like freaking offloading their load on retail. Okay. So we could, again, there's more mathematical formulas. You could go ahead and understand this whole thing. And you can look at, this whole thing is called the liquidity absorption ratio. This equation tells you how many days of normal trading day it would take to absorb all the institutional selling at a specific price. Think of it basically how long the selling storm will essentially last, right? Let me go ahead and okay. And you can see that at $14, the LAR is 865%, which means that it'll take about 8.65 days of total daily volume just to absorb the institutional selling. But guess what? The volume now is high. So most likely it'll probably absorb it within a day, right? You'll probably get that absorption within a day. So again, guys, very dangerous, very, very dangerous, right? When the LAR exceeds 400 to 500, it creates an almost insurmountable wall of supply. Any retail buyer gets immediately overwhelmed by institutional selling. But guess what? There's a change in the algorithm now, because now you have somebody saying that the stock is going to go to $82, and there's retail investors that believe you, to where even the LAR, even if it goes to 400 to 500%, doesn't matter, because you're going to have retail investors buying all that, and institutions love that. Smart money versus dumb money. And all I'm saying is, if you have someone who has a past selling history, who's sold at $14, for crying out loud, who sold at like $9 and $4, and so who sold at $1.16, but definitely sold at 14. It's just something doesn't add up here, guys. And again, I get it. Sometimes everyone's excited, pep rally, and I'm bringing a calculator. But at the end of the day, you got to look at the work that we're presenting here, right? And, you got to just kind of look at it and listen, like, hey, man, this guy's making a little bit too much sense. Okay. Okay. So what else? We could go ahead and talk about the volume weighted analysis of major liquidations. We'll do that. We could do that. But this gives you kind of the overall estimated losses. Again, guys, a lot of these people, like, for example, Morgan Stanley, $13, they're at a $70 million loss, right? So what's going to happen when they get to $13, $14? They're about to sell. Are you kidding me? They're about to sell on retail investors. They're about to take retail investors to the ringer. Right? No one wants to basically talk about these folks. You know what I mean? No one wants to say anything. Right? But this is Wall Street. They're nasty. And you know what's going to end up happening? If I was if I was institutions, I would amplify. And this is what they do. This is very nasty. I would amplify. And by the way, for example, if I'm an institution and if I buy a stock and if I sell that stock, I don't have to report it. We went ahead and verified that before. We can go ahead and verify it again just to be extra sure. So I have a question. So if institutional investors, how if they buy a security, they would have to report it to the SEC 13F filing. So let's say if someone bought $25 million of a stock, but then sold $25 million of that same stock within that 3 same month period, do they even have to report it, since by that filing date, they're not holders anymore? Look at how nasty the game is. So, especially, this also happens when it's shorting, right? So again, it's giving me all this garbage, and you can see the answer here. They do not have to report it. But again, I'm just going to ask it again. Listen, I'm not looking for a novel here. Just answer the question in one sentence. Yes or no? So it's saying no, right? So that is wrong. So let's see. So 13F, they do not have to report the, so it says here, what if they sell before the quarter ends? If the manager bought, so my apologies. I misunderstood I said explain it in a sentence. Please explain it in a sentence, not just one word. There it is. So because it didn't explain it in a sentence, it answered it correctly, but I wanted it to explain it in a sentence. So it didn't listen to me. So this is the answer. So the answer is correct. It's no, but I wanted it in a sentence. So no, they do not. Let me zoom in before, right? No, they do not have to report it on the Form 13F if they sold the entire position before the quarter ended and held no shares at the end of the quarter. So if an institution goes in and buys, like for example, right now, right? Let's say I'm a hedge fund, right? And I want the stock to go up higher. I will put in $5 million right now to spike this bad boy up. Okay. So if I basically I can spike this up, and then all of a sudden it gets in momentum. Retail investors come online. And let's say, for example, it goes higher, but then I sell 5 million out before the earnings, before the earnings of that, institutional ownership, where they have to sell the 13F filings. They have to show that they bought. If I sell before that date, then I don't have to tell the government anything because I'm not a holder of the stock. So you see how nasty the game is, right? So institutional investors know this. So what they do is they short the stock, and then by the time the filing date happens, they remove their short. So you won't even know they shorted the stock. So this is how nasty Wall Street is, okay? So now going back to this whole thing, if this stock goes to, let's say, 10 to 14, 13, whatever dollars, best believe that these institutions are going to sell. And guess what? You also have, it's like having like a bunch of crocodiles in different ponds. If you pass the $2.04 pond, $2 to $4 pond, you got 34% of selling pressure, right? But then once you get to the $8 pond, you got there's multiple levels of institutions are going to be selling. And what they're going to do is they're going to say, well, hey, I don't want to sell at 6. I want to sell at 12 to 14. Let's give these retail investors more gunpowder. Let's keep spiking this up. Let's give some crazy call options that are leveraged, that are derivatives of derivatives, right? And let's spike this up, and let's just have these, let's have greed get to their mind. And these people are going to basically put their entire net worths in the stock, and they're going to end up basically holding the bag because the free cash flow net income is not holding the stock. And remember, a stock stabilization is the, all the culminations of its future free cash flow. Okay. So for example, if you invested $10,000 and open at $14, this formula says that you have a 95% chance that you'll lose about 51% of your money. So a lot of people are going to buy at the 10, 11, 12, 13, 14. They're going to buy at those regions, and they're going to end up losing 50. They're going to lose half of their money. And who knows, people, let's say buy at 10, the calculation here for the retail investor calculation, they're about to lose 34%, right? They buy at 14, they lose 51%. They buy 18, lose 4. Again, guys, this is if you invest $10,000. And it's funny because if you look at Clover, it's a totally different picture for Clover. Okay. Then you can also look, there's something called the meme stock vulnerability index. This equation creates a danger zone for meme stocks by combining volatility, retail investor excitement, selling pressures, and trading volume. So the higher score, it essentially means danger. So Open's MSVI is 8.7, is way above the critical threshold of 5. So this means that Open is extremely vulnerable to institutional manipulation during retail-driven rallies. So when retail gets excited and starts buying, institutions are ready to dump massive amounts. Again, guys, you can, for all the mathematicians out there, follow the math. Look at all this, guys. You know what I mean? So this is some really good stuff. And I don't want to be showing off. my equations to hedge funds because I don't want them to know that I know what they're doing. I don't want to show this, but I'm not going to show Clover so they can't see what it says there, right? Right. And again, it's all for educational purposes. All right. So let me think here. Okay. So yeah, this is just me retweeting Benjamin Graham, Intelligent Investor. He said, in speculative markets, what counts is imagination, not analysis. And this is what we're doing. We're pure analysis, right? We're pure analysis, and sometimes people don't like that. People like imagination. This is us saying the same thing, and then this is basically talking about the trading volume we talked about. What I want to talk about is there's a guy, and you're not. So now that we kind of gotten this, now let me show you something weird. Okay, so you're not going to believe this. Look at this guy. So there's a guy, 14. I guess he's a 14-year-old. I don't know. That's what his name is. But there's a guy. He basically tells me, Albert Allen is completely off base here. His track record speaks volumes, especially with his flagship pick, Clove, which has been languishing. It's been languishing in the $2 to $3 range for what feels like an eternity. Oh my God, right? Like my tickle box is so tickly. Like what like what is this guy talking about? Languishing, what it feels like an eternity? Okay, let's go ahead and let's use data. Let's see how long it's been languishing for. Okay. So let's go ahead and pull the we have to go here. Let's just kind of scroll down. And let's just pull this screenshot we took of another person. Again, you see how these folks, they say the same thing. It's almost like a NPC. This guy said the same thing. He's been talking about Clove for 2 years and it hasn't gone anywhere. Okay. Let's look at the facts. April 19, 2024 to the July 17, 2025. In 15 months, Clover Health up 376%. Actually, it went up to 600%, and now it's consolidating to 376%. So in 15 months, we languished up 376%. Oh my God, what a languish. Okay. Again, this guy doesn't know anything about free cash flow. I've made, again, a lot of money on this, and a lot of people made a lot of money as well. But again, it is what it is. This guy is definitely, if you want to go ahead and read what he says, it's just a bunch of garbage. All right, now, let's go ahead and let's read this part, the highlighted. So are you ready for this? So check this out. That's why I'm confident going all in with my entire net worth. So this guy is about to go all in with his entire net worth. Right? Does this guy seem like dumb money or smart money? I mean, this is literally who you're basically competing against. He's literally saying Clove was languishing for, again, we've talked about that. We proved that this is full of shit. And he did this on purpose. I don't know, maybe to upset me. I don't understand. I'm not really upset. It makes you look like an idiot. Right? And then he says, I'm going to put my entire net worth. But guess what? Guess how stupid this guy is. Are you ready? So I'm going to put my entire net worth on open. These so-called helpful critics are nothing more than disgusted bears trying to scare off smart money. So, and it's downright infuriating. So he's basically saying my critique is scaring off smart money. Do you really think smart money is going to be scared off by a critique, or they're going to, or you think smart money is going to be looking at the data, right? Again, I mean, does this really make sense? This guy seriously thinks I'm going to scare off smart money. Like smart money is going to be scared off because I'm saying free cash flow is negative and net income. I mean, again, guys, these are the people that we're going to be dealing with when Clover becomes profitable and it shoots up. You're going to get people that are going to think it's squeezing and it potentially could squeeze, right? And you're going to get a bunch of people that are going to be like this, and this is fine. They will be our exit liquidity. Okay? And for folks out there, if you guys want to see the data of what it says for our mathematical model of what it says for Clover, which we basically have right here, you're going to see exactly at what levels they're buying. And let me tell you, it is very bullish. It is bullish. It is very bullish. It is more bullish than Michael Saylor's stick. Let's put it that way. Okay. All right. So there's that. So now let's just go ahead and look at Open and just try to show you here. So here's that institutions and the price went up and then they dumped on them, right? So we're not even talking about 20. We're talking about here. You see this big dump, and this is what I believe Close to Retirement was mentioning. Okay, so we talked about this. We talked about this weird, oddly person, like just really just. And I mean, again, guys, I'm very direct. I said let's take a moment and learn from a textbook example of dumb money. Again, guys, I'm sorry if that's too direct, but this is really this is textbook example dumb money, right? Unfactual data, confident they're going to go all in on their entire net worth, and just a bunch of slew of bullshit. Anyway, so there's that. Okay. And we talked about this. We talked about, okay, yeah. And then, people are saying sell the rally. And that's what happens, right? Institutions are going to be selling the rally. And then I go in and I'm trying to basically ascertain this gentleman here, trying to figure out exactly kind of what, in terms of, from a respectful level, this gentleman now basically says it was $82 and then now he thinks it's 40. And my response, is like, okay, fine. Let's break it. If you think it's $40, which we just showed you, the institutional selling pressure is heavily around $14, right? We already showed you that, right? So imagine what $40 would look like, right? Institutions would offload the mother load, right? But okay, that's fine. Let's just continue on with his simulation. Okay, so the stock is currently trading at $2.25 with $1.64 billion market cap. So at $40 per share, that places them at $29 billion market cap. Okay, so that's 52 times the multiple of cash they have. Does that sound right for you? Does that make sense? And if someone truly believed that, what happened? Like I don't want to go into any conclusions, but it just doesn't make sense. I'm just following the legal SEC document filings here. Okay. All right. So we talked about that. Now let's go ahead and talk about Opendoor's short interest. Yes, this short interest let's just look in the past week. It went up 17%. It's at 23% right now. Okay. This has a high probability of short squeezing. Okay. Why? Because you have a lot of folks that are coming online. But guess what? Institutions are going to love to dump on these folks. So I think this is what I think is going to happen. I think the stock price is going to explode. And you're going to get, in fact, let's look at the overnight. Let's look at the overnight here. So overnight, the stock is around $2.93. That's a 30% increase. So what's going to end up happening is you're going to have the stock slowly start creeping up. And as the stock price creeps up, institutional selling pressure is going to continue to increase and increase. Because why would an institution end up basically holding on that risk, right? Like if I was an institution, let me just sell, because definitely when a stock price goes up this much, there has to be a consolidation period, right? And remember, just to be very clear, the stock price is up from this bottom here, 341%, right? So what I think is going to happen is you're going to have overnight trading go up, open up high, and either then you get activation of shorts trying to basically pull it down. You have a Q2 2025 earnings on August 5th, which again, if they show EBITDA profitability, or somehow if they can pull a Houdini and they show they're negative 5 million or negative 10 million or negative 3 million or negative 2 million or negative 1 million or 0 or 1 or 2 million of GAAP, real profitability, then that's it. Sayonara. This stock is going to shoot up. It's done. Game over. Checkmate. This stock is going to go. Question is, how much is going to go? Okay, let's go ahead and answer the question. To answer the question, you would have to, again, go to our stock terminal. We'll push this here. We'll go to the financial data analytics metrics chart. Again, for folks that want access, coupon code is SAS, $1,200 off, one-time payment, lifetime access. I went from nothing to becoming a multimillionaire. We have multimillionaires in our platform. And again, this is one of the best platforms out there. And you could go ahead and talk to any lifetime access members and they'll tell you. So to do that, let's go ahead and open this up, open, right? And by the way, just a quick shout out. We got right now, very quickly, let's take a little screenshot here. We got about total 692 people listening, about 611 people from X, and about 81 from YouTube on this live right now. So that's impressive, right? And this is just us basically posting it live. We are live right now. So if you're watching the replay, welcome. Okay, so let's go ahead. So to calculate the free cash flow of Open, you would have to do estimation since they're free cash flow negative. So to do that, all you got to do from this region is 5153. So that's pretty much what you got to do. So you got to take 5153, multiply it by 5%. You do that, that's 257 million of free cash flow. So we'll put Open here, and we'll put the free cash flow of 257. Let's try to be accurate, 257.65. Okay. But now we have to calculate the growth rate. No worries, we could do that. We could go ahead and look at analyst estimates, and we can open up a new terminal. And let's open up progression analysis software. Again, it's all lifetime access. We give you access to data, right? And the ability to learn how to use the data. All right, so let's look up revenue estimates. So right now they're at, we just said it, 5153 at 2024. So we put this here and we put 2024. These are 2024. And then we can look at analyst estimates. Again, it's very difficult to do this, but it's dangerous, but we can look at the growth rate from here, which is fine. We'll look at the growth rate average. Or we could just, it's fine. We'll look at this one. The growth rate average in 2028, they're expected to make $7.8 billion. So 7847. 7847. And this is in 2028. So when we calculate the CAGR, we got an 11.09% growth rate. Okay. We put the 11.09. We hit enter and we look at the classics view. We see a stock price anywhere between a recession case of $2.81 to a best case of $8.70. So based off of 5% of the current revenue of 2024, based off of what analysts are expecting this thing to grow to, and we could go ahead and it's better to use the long range number. We can look at another way to look at growth rate. We could see, I think there's more shorter range. It's a higher growth rate. So we can look at that. So I can give conservative cases. And so we could say next year they're expected 19%. Okay. So I'm going to give you two ranges. Okay. I'm going to go ahead and give you the range of the base. So we'll put that here. This is the base range. And listen, guys, our platform, you're able to calculate your own stock price, right? You're able to calculate your own price target, right? Using actual numbers. All I'm doing is I'm using numbers from here. Numbers from their financials gives you actual worth of the stock price, right? And just to kind of take a quick diversion, let me give you an example here. So for folks to understand kind of how powerful the software is. So let's look at CVNA. Everyone's talking about Carvana, right? So when Carvana in 2023, they're around $4, okay? Now let me show you something. If you type in Carvana here are Carvana's financials with this revenue, net income, and free cash flow. You could see that Carvana turned operational cash flow in 2023, right? So let me show you something that's impressive, okay? So what you can do is we could take the screenshot. We won't do 2024 numbers. We'll just do 2023 and we'll stop at 2023. Okay. And we'll go here and we'll go here. So I'm going to use the numbers just for 2023. And then what we'll do is we'll open up a new financial sheet. Do we have another one? Let's see. We'll open up a new financial sheet here and we'll do another price target, but this time for Carvana. Okay. So we'll look at it here. We'll say CVNA. Okay. And this time we will reset all these numbers. We'll put them all, zero them out because we're going to go ahead and recalculate it all. Okay. We're going to use the numbers from here. So to do this, we'll say 2020, they made $5 billion. This shows you how, I'm just showing you how accurate this is. So this was in 2020. We're just calculating the CAGR. Okay. So let me just kind of stick this next to here so we can see it. So we're calculating the CAGR. In 2020, again, we're all using 2023 numbers here, right? So in 2023, they made 10.7 billion. Okay. So we'll put it here and we'll say 2023. So their growth rate now is 24.46. So we take the 24.46 and we put it into the price target here, growth rate, 24.46. All we're using is the number from the financial sheet. That's all we're using. The outstanding shares in 2023 was 109.32. Okay, 109.32. And the average free cash flow, we could say, you know what? We could say 10,000 multiplied by 5%. That's about 538 million of free cash flow. But guess what? They actually got 716 million of free cash flow. So we'll just use the 716 million. So let me just go ahead and remove the comments as you can see. We'll use this number, 716 million. Okay. Let me put the comments again so you guys can see. All right. So, right. So let's go ahead and put 716 million. And the stock price, what was the stock price in 2023? That's fine. Stock price, let's anywhere between $4 to $8. Let's say $9. Screw it. Let's say it's $9. Okay. That's the current stock price. Now let's go ahead and hit enter and watch our intrinsic value software calculate the price target when the stock price was $9, utilizing the financial numbers that we had at the time for Carvana. We do that and we hit a classics view and you can see Carvana's price target is anywhere between a recession case of $100.74 all the way to the best case of $424, which shows a 1,000% gain all the way up to a 4,600% gain. Ladies and gentlemen, are you seeing the power of the Al Stock Trades platform? We are giving institutionally graded data access to retail investors, which has historically been reserved for hedge funds. So you can see how you can calculate the stock price before it actually goes up, but you're not using hype. You're using data. I use data in 2023. I use data that's backed by numbers, right? You understand what I'm saying? That's why you see, right? So essentially it was around $8, we said, right? $8, $9. And then what is the price target now? What is the actual price? $347 with a high of $364. Okay. And you see how we use 2023 data? And you can see right here. So the stock price right now for Carvana is between the base case and best case. And again, if you don't know what this means, if you don't know how to do it, that's fine. We have members join and they're able to do it within 30 minutes, right? And you have access to lifetime access members that will help you answer your questions. And also you have access to me, right? With over 14 years of experience. Okay. For folks out there, if this is making sense to you, there is a better way to understand the stock market. There is a better way of calculating your own price target. You don't have to rely on analysts, right? You have your own GPS. Okay. So now that you've seen this, now let's go ahead and remove this and let's go ahead and talk about Carvana. Let's go ahead and talk about Open. So we calculated Open, but we used a 11.09% growth rate, which is the estimation. Let me see if I can find it here. We use the estimation of the revenue from 2029. So let's just be short term. Let's use the estimation of 6,395. So to do that, we'll just say 6395. This is in 2023. It's actually 2026 estimation, which you can see here. We're just changing it up. And now let's look at the growth rate. And this growth rate, 558.86. This was Opendoor's growth rate. So let's go ahead and hit open. Open is around 5153. So 5153, and that was in 2024. We calculate that, we get a even then we get a CAGR of 11.4%. So I mean they're having it grow 11.4%. I mean I don't really see. Yeah, so I guess we can do an ultra bull case, which I don't like to do, but that's fine. We will go ahead and do that. So if we do an ultra bull case, we could do 19.05%. And that was the number that we took from Yahoo Finance, which is this number here. Let me show you. So you can see I'm citing my information, right? We take this number here, which is 19.05%. Okay. So by doing this, we put 19.05%. We get a stock price anywhere between $4.35 to $15.53. So you can see it's right near that institutional selling pressure. So now I'm going to take two screenshots. Okay. And I'm going to find the other one that we did there. I'm going to exit all this noise. Okay. I'm going to put it here. Okay. So ladies and gentlemen, there are two screenshots that I have. And this is for the price target of Opendoor. And this is assuming Opendoor is free cash flow positive, and we estimated free cash flow by taking the revenue and multiplying it by 5%. By doing that, you get a let's call it a base range of anywhere between a recession case of $2.81 to a bear case of $4.90 to a base case of $6.32 to a best case of $8.70. From the bull case, well, first off, before we show the bull case, we got a growth rate of 11.09% because we took the CAGR from the year 2024 to the CAGR of 2028, utilizing our CAGR calculation, which you can see here, and we got 11.09%, right? Well, when we first did it. If we go ahead and take the growth rate of what Yahoo Finance was saying, then now, which I'll call the bull case. Again, all we're doing is we're just taking the numbers here, right? We got a recession case of $4.35, a bear case of $8.21, a base case of $10.93, and a best case of $15.53. So you can say, if you culminate both of these intrinsic values together, you get a recession case of $2.81 all the way to the best case of $15.53. But you can see how that best case, it's at that $15 range. And if you go back to our quantitative mathematical model sequencing, you could basically see here that $12 to $14 is where institutional selling pressure is at its highest, backed by a p-value of less than 0.001, which shows a risk classification of extreme, meaning that institutions, because trust me, they've ran these numbers and I'm showing you these numbers, they're going to most likely be selling heavily in this region. So that's why I'm skeptical when someone says it's an $82 stock price, right? I'm skeptical when someone says that, then all of a sudden changes it to $40 because I'm not seeing this based off of the numbers. I would love if somebody can show me the numbers, right? I've been doing this for over 14 years. I just showed you Carvana, how you're able to take Carvana anywhere between $4 to $8 and predict that it's going to go to $300 to $400, right? And guess what? You could have predicted it even earlier. You understand me? This is the power of the intrinsic value calculation. This is the power of our software, right? That's how I went from being literally having nothing to becoming a multimillionaire. That's how our platform was able to have with a 30% response rate of people having over $45 million. That's how someone was able to turn $70,000 to $1 million, right? It's using data. It's data driven. You understand what I'm saying? So a lot of people are calling me, I'm a bear and this and that. No, I'm not saying that. All I'm saying is be careful. There could be value here, but you're assuming that they're going to be free cash flow positive. And I just don't see it. right? They need to prove it to me before I put my heart. Again, I don't know about you guys, but I work hard for my money, right? I work hard. Okay, because again, this is negative free cash flow, guys. And again, have they improved? Yeah, they can, right? And you can see, they were at 664, and we put them at 256. I mean, there could be an opportunity here, right? But they have to prove it, and we're only using 5%. And look at the gross margins. Yes, the gross margins have been improving, but this is not a high gross margin business, guys. Now, are they switching business models? Yes, potentially, but they need to show us that, guys. And if you look at the most recent quarter, its gross margins is still 8.59%. They haven't proven it. They haven't proven it to us. So you see what I'm saying here? It's all data. I'm using numbers. That's all I'm doing. You're arguing think of me as like Al Stock Trade's Chat GPT. I'm like a GPT, right? I'm all data, right? When you talk to me, you're talking to like my mind, which is like composed of data. That's all I am. I'm just data, right? Think of me as Cortana from Halo. That's all I am, right? Okay. So there's my spiel there. So now let's go ahead, exit. And now let's go ahead and generate a report. This is like an institutionally graded report. It'll go ahead and show us very professional, nice and sleek, right? Okay, and this is the report. Again, you get access, everything I've been showing you, you get access to it. You get access to our data, right? So for folks out there, again, this will be expiring soon. Coupon code SAS, $1,200 off, one-time payment, lifetime access. You get access to over 2.5 billion outputs of institutionally graded data, access to me, access to our internal lives that we have, access to our future meetings, access to how to do the covered call and cash secured put strategy, the wheel strategy, how I'm going to be showing you how I make $200,000 to $800,000 per month. I've already shown you how I made $40,000 per month, right? And then how to basically take that and put it in properties, right? All right. So based off of that now, let's go ahead now and show the confidential equity research report here, generated July 20th, 2025. So you can see right now, this is backloaded. It shows that this thing, it needs more data for the Monte Carlo. Again, the stock has been sleeping. It needs more data for the Monte Carlo simulation to essentially extend itself. But we're starting to basically get uptrended, and the weekly will soon become an uptrend from a technical analysis perspective. So this needs a little bit more data to actually do its thing. So we broke out of all of these lower resistance levels. Now the game is 235. We passed that. The next level of resistance is $3.31. Again, this uses AI. Right, is again all part of our lifetime access, right? This uses AI to automatically plant support and resistance lines, and it's very accurate. And you can see we already passed 235, right? That's done, right? I think it's going to open up past that. We'll see, right? And then 331 is going to be the next level of resistance. Then 439. Okay. Then you have 642, 1263. And 1816. I'm not even going to talk about the 23. You have a lot of institutional selling pressure here. Like I told you, backed up by the research I have for the quantitative analysis method that we went ahead, which you can see here, all the mathematical formulas that we went ahead and showed you here, all the data and research that we provide at Al Stock Trades. Okay, so then now we go ahead and you can see 976, 1566. Again, lots of institutional selling pressure here. Then you have these other ones here. Then we go ahead and activate the Fibonacci sequence retracement levels here. And you can see, we're 229. We're about to pass it. After this, 289, 345, 415, 548, 937, 1211, 414. So what people can do from our lifetime access for folks that are following this and, are essentially day trading this, you have to take, you use this to help, right? And then you also use algo flow. Again, algo flow, you could go ahead and take a look at this flow algo. This individual goes ahead and charges $99 a month. Well, guess what? Ours is lifetime access thanks to our third-party distributor here. We go down here, and we have access to this data as well. You have access to this terminal and the terminal on the stock terminal here. You have two terminals, right? Algo, we put open, and then we put numbers, and we put 5. So now let's look at what the options chain is showing us where open can go. Now, based off of this, open, as you can see, the options is showing positivity, which means that it is pricing that the stock price is going to go up, right? So there you go, right? So from the options perspective, this is going to go. And a lot of folks are checking this regularly because it's very accurate, right? All right, so there it is. There's the, 51 cents, 548. So that's pretty much, the next level there. Then you got 8, 14, and an 18. And then this is the issue that I have. A lot of institutions are selling investor holdings. They're selling, right? Let's, again, totally invested going down, ownership percent going down, number of shares going down. They're offloading their shares, right? They had about over 460 million shares, and they offloaded like more than 100 million shares. Who bought it? Retail. Okay. And then you have the historical view, and you can see, look at the investor holdings. They're going down. Again, yes, you may get excited. You may be salivating at these data-driven price targets that I'm showing you, but you have to also look at this too. As a surgeon, you look at the risk and benefits. Listen, guys, I'm not going to go ahead and be a prima bull and tell you all the positive things about something. A lot of people confused me this with Clover. They're like, oh my God, he's just a Clover bull. Listen, guys, I see more positive for Clover than not. Even the chief financial officer was saying that this is an undervalued stock and quoted Benjamin Graham, whom we quote all the time, whom our intrinsic value calculations is derived from, right? Using software. So again, I'm giving you the good and the bad. There's a lot of people out there that'll only give you the good. And unfortunately, you got to stay away from those people. What kind of surgeon do you want? The surgeon that just tells you all the good things, or that basically tells you all the good and the bad? The reason why a surgeon is able to tell you all the bad, not because he's a bad surgeon, because it's called experience. You want to have a good surgeon? You want to have an experienced surgeon, or do you want to have a new surgeon? It's all about experience. I have over 14 years of experience in the stock market. I've seen these things play out, right? And I'm just giving you the good and the bad. And then you ultimately make the decision, because you are the CEO of your portfolio. And the whole point of our platform, again, the mission is simple. Let me show you the mission, okay? The mission is simple. It's to empower retail investors to win against Wall Street. It's to empower you, right? That's the whole point. It's to empower you to get ahead, right? That's exactly, again, guys, I came from nothing, okay? Hold on, let me show you. Okay? I came from nothing. From homelessness to receiving 3 degrees. I went from homelessness to becoming a multimillionaire, guys. Okay? And you guys can, I publicly disclosed it. Let me show you here. You can go ahead, go lives. And we're going to be bringing back the portfolio online soon. But yeah, you could see, I went ahead and have a public portfolio. We have a larger one that has over $15 million. This system works. You can see the public portfolio. I went from homelessness to becoming a multimillionaire. 1.1, 1.7, 1 point. And you're going to see this portfolio that's publicly open. It's going to end up going to 10, 15, 20 million, right? Because that's what happens. Data-driven investing works. Working really hard is what successful people do. And that's what I'm trying to show you. And that's the community that we're building. It doesn't exist online. So I decided to create it myself. Okay. Analyst estimates. Yeah. The revenue went down. Now they're expecting it to basically turn back to becoming, we should be seeing a revenue increase, hopefully 2026. That's what analysts are expecting. So this is going to definitely be, potentially the case. But again, a lot of, in terms of Wall Street, they're a bit skeptical. They're thinking still unprofitable. But again, I don't really listen to Wall Street. I just look at the data, right? A lot of these can be manipulated. You got to be careful, right? Again, speaking from experience. So there it is, guys. That's pretty much it in terms of what we talked about. Any questions, let me know. But that's pretty much it, guys. So if you're out there, shout out to the 65 people on YouTube and the 782 people. We have about 847 people watching in total. We have the lives distributed at the same time on YouTube and X. Again, this is the power of our platform, okay? And if you want to join a place that has no BS, no bullshit, take advantage. Appreciate you all. God bless you, and I'll see you on the next one.